Hi, everyone. Thank you for coming to the Seattle Angel Conference Workshop Series. Today, we're going to have Alex talk a little bit about the deal terms you need to understand in your angel investing context and your startup. So I'm John Seacrest. I run the Seattle Angel Conference. I also run the Transatlantic Angel Conference. And so our goal is to create new angels, and we run a series of workshops. Alex, want to dive in?
I would be happy to. So we're a small group, which I enjoy, because that means that we can jump in with questions. So don't feel the need to raise your hand. I should probably do a little bit of a pause in each of three sections. Yeah, if you have a question. So I'm just going to share my screen here.
Yep.
Let's see this.
Yep, looks good.
All right. I seem to have lost the screen where I can see the rest of you guys. Now here it is. Okay, so as I was saying, feel free to jump in. I can see all of your faces. If you have something to say, just kind of jump in and let me know. We might not take the full 2 hours. I put together the presentation really, I like to call it for part-time investors. And I call it that just because full-time investors, and I think, I forget which one of you it was that said that you might be looking to become an associate and do this full-time, will go into much more depth. The challenge is often for those of us who aren't necessarily finance professionals to say, well, how much do I really need to know? How much of all the legal jargon in deal terms do I really need to know? What should I focus on versus what is boilerplate in the industry? So a lot of what I'm going to try to cover is a little bit of my learnings along my own investment in angel journey about what matters and what doesn't. So this is not meant to be a comprehensive review on deal term, but more kind of a way to kind of maybe help you focus on what might be most relevant things to look for. So real quick, I want to kind of start with a little bit of an introduction to my involvement in all of this. I've been an angel investor for about 6 years, since 2016 or so. I have about 22 companies in my portfolio, and most of my investments have been through a fund or as a limited partner, they say. So I've not dealt with the deal terms in most of those cases. However, I also work in corporate investing and deal structuring, and so I've seen terms on that side that are quite different, but I'm familiar with the legal frameworks of a lot of what we do here. That being said, currently I'm the fund manager for the Seattle Angel Conference 22, which is just wrapping up. A little plug for you guys: if you can join our final pitch event next Wednesday, you'll get to see 6 fabulous companies and learn more about what they do and kind of see what the tail end of the Seattle Angel Conference looks like. We have a new cohort that's starting in the spring, and if you're looking to participate, then Tessie Decker or myself will be the person you can contact. We can give you more information. But what we, excuse me, jump over here. Just for some context, if you want to get into more deal term, the way that process has worked through SAC and the way it's worked for me personally is that many of us have maybe started to learn through either investments with friends and family or through a group like the Seattle Angel Conference. And then we go on to build a portfolio. As John said, if you want to be an angel investor, it's important to diversify and to build your portfolio. But within the Seattle Angel Conference, and also at the various different funds, there will be a fund manager who's often the lead on negotiating those deal terms. So within SAC, we have a different fund manager for every cohort. So I'm the fund manager for the one wrapping up now. There'll be a different one for the one that's coming up. And as a fund manager, it's also a great way to learn in a community environment about what deal terms look like and how different companies present them. So this is a little bit of a distillation of some of my own personal learnings. And what I'm going to cover today are really kind of 3 sections, and I'll pause after each one to see if we have any questions or discussion we'd like to engage with. One is just at a really high level, what are some of the common types of seed financing we're talking about here? So when we talk about deal terms, we're not talking about corporate restructuring. We're talking about things like convertible notes and safes. Second is, when we look into those, what are the deal terms that we actually look at and review? And then the third is just a quick high-level perspective on what really matters and what doesn't, and this will be my perspective. So I want to caveat this by just saying this is my perspective. There are very hot debates on Twitter amongst finance professionals about what matters and what doesn't. And it's vastly oversimplified. And some of you may actually know more about a particular aspect that I'll talk about than I do. So feel free to kind of share your knowledge, and you might hear a different perspective from other people. It's really kind of my take on that. Okay, so real quick, we're talking really as an angel investor, there are broad buckets. I would say 3 types of financing you should at least be familiar with. The first is the convertible note. The second is the SAFE, which stands for Simple Agreement for Future Equity. And the third is what I would call a priced round. Any one of those could be in a seed investment. Typically, you don't see a priced round. You think about that a little bit more in a Series A or Series B investment. But I have seen, and we have one right now in Seattle Angel Conference, for example, that is doing a priced round in what they call a Series C priced round. So you'll see that as well. But the gist of a convertible note is that it's debt. So it's basically a loan, interest rate, and a maturity date. It said this loan is due, say, at the end of 18 months or 24 months. But the goal of the convertible note is all this other term to basically say, when you have a priced round, when you basically get equity into the company, we want that investment that we lent you as a debt to turn into equity. That's kind of what a convertible note is. The SAFE is basically a convertible note, but without the loan. So it's something that just kind of says that we're going to give you money now. When you get a priced round and you get equity, we want our money to convert into that equity. So it's a general high-level rule of thumb. Convertible note to some degree kind of favor the investor because at number one, there is a little bit of a push for the investor to say, I want to stop paying the interest rate and I'd rather get to equity. So I'm going to move in that direction. And it's also, and it also favors the investor because you can put in clawbacks there to say if the convertible note is not, the company is not getting to an equity round, you can call the note and at least get your money back. Hopefully more than just the money you invested, but at least there is a mechanism for doing that because it was a loan. A SAFE, on the other hand, sort of favors the investor, the entrepreneurs a little bit more because none of that exists. So the investor's not on the hook for anything except thanks for the money. When I get to an equity round, I will I'll pay you back. So we see both of them in seed funding. Interestingly, SAFE's a little bit more common in the Bay Area. Convertible notes a little bit more common up in Seattle, and the mix has changed over time and probably will change right now. It depends a lot on who had the power in the negotiating process. And then the priced round is really what everyone is hoping to get to. A priced round is essentially where the company actually has shares. So convertible notes and SAFEs are not shares. So it's just a promise for shares, essentially. So in a priced round, you actually get shares. And so when you hear about a price that says, the shares worth 5 cents a share, that's what the priced round is. You can add up the shares and say, this is what the company's worth. So, so that's the distinction between the 3. Any questions there? That makes sense.
So there are a lot of other pieces, like Calm Fund has their own seal thing, and there's the KISS thing, and all of these various versions of this. Have any of those come up in the conversations for you that strike you as being anything different than what are in these 3 broad categories?
I have not personally run into those kind of deal structures. I'm familiar with them, but not terribly familiar with them.
Okay.
All right, I want to say welcome to Bill, Dennis, and Eric. Do you guys want to introduce yourselves real quick, maybe?
Hi, I'm Eric. I'm participating in the SAC this round as a first-time angel investor.
Hi, this is Dennis. I have been with SAC since SAC 19 and currently participating in SAC 22 as well.
And Bill, how about you?
Hi, I appreciate the opportunity to meet and connect here. My name is Bill. I am working with JV Genius based out of Atlanta, Georgia. We help professionals to diversify their income and building wealth nationwide. If diversifying your income and building wealth nationwide even remotely interest you, you can reach out me by email. Thank you.
All right, thank you. All right, I'll continue with the presentation. Want to kind of maybe share on a really high level where we are in terms of the schemes of investing. So typically, I'm going to focus on convertible notes and safes simply because they are the more common used in the early part of seed investing. The goal of these investors is often to support the company to get to a price round. Remember, the convertible note and the safe are only worth something by and large if there is a price round. So we come in early, we get favorable terms. I'll talk about what that looks like and why they are favorable in order to help the company really raise additional funds once they de-risk the company at less favorable terms and to raise more money. So this is kind of the area that we're focused on here and in the spectrum. Friends and family investments early on also use convertible notes and safes. But sometimes at various different times because they have a personal relationship with the founder often.
It looks like Mateo has his hand up.
Yeah.
Yeah, I was actually gonna ask a question about the three different types of securities or products that you described in the previous slide. Sorry if I came in late, but I guess my question is my understanding is that safes and convertible notes mostly postpone the conversation about the valuation and the price of a company till a later point. And safe, even more than convertible notes, are simpler. There's fewer things to discuss. But I guess I'm curious about your perspective because it's we were talking about it today during our tech meeting. It's really hard to have a good sense of a valuation of a company in such an early stage, but at the same time, agreeing on this is also what I heard from John, agreeing on a price round or agreeing on a price rather, avoid some maybe headaches down the line. So I wonder, while two of them, the two at the top are easier at this point, but maybe they lead to more headaches further down the line. So I wonder what your perspective is in terms of agreeing on a price or an evaluation earlier rather than later.
We're going to spend a good chunk of the presentation talking about valuation, because in my opinion, it's one of the least understood parts of the company. And in some cases, the process, and in some cases, the one you can get the most wrong. So I'll give you my perspective on that in a minute.
Sounds good. Thanks.
I think the things that affect one round to another are often more the smaller clauses. And I'll touch on those briefly, but things like most favored nation sometimes will be like, oh my God, now I have to go back and upset a previous investor or a future investor because a most favored nation guaranteed terms relative to one round to another or one investor to another to some extent. Valuations, I think, have less of a complexity that way, interestingly enough, but they certainly affect your returns as an investor and the amount of equity that you'll ultimately own. So we'll touch on that briefly. Okay. So just my high level perspective, how well do you really need to understand terms? This is a simplified, I think, matrix of my perspective on this. If you invest something passively through a fund, the fund manager will typically be the one kind of handling that. And you can ask, but ultimately you're going to have relatively little say in it anyway. Plus there's someone dedicated to focus on that. The attention is maybe best looking at just the quality of the companies themselves. If you're investing directly with the company, or if we say you're getting on their cap sheet itself, so you definitely need to know, because that agreement is something you're signing yourself. And so you should at least be aware of what you're signing. And then if you're investing as an active limited partner in FPV, kind of like what SAC is, where we're voting on companies and saying, yes, we think the company A should receive our investment instead of company B, and you have a very active voice in that process. I would say it depends. In the case of SAC, as a fund manager, I run those negotiations. We are choosing between companies, and occasionally you have one company where a deal term might make the difference in what you would choose to invest, but it can also be a rabbit hole. And so the degree that the FPV can be structured to where that that analysis and responsibility resides in someone who had the subject matter expert, it's probably a good idea. So we create this kind of opportunity to share the thought process around deal term, but in SAC at least, we don't necessarily make that as an active part of the due diligence process for that reason. That makes sense. So what deal term do we review? So first, a couple of things that I wouldn't call necessarily deal term, but they kind of frame the process a little bit in terms of agreement that are signed between an investor and a company. One is the NDA, non-disclosure agreements. Sometimes companies will ask for them before they even get into negotiation or they'll do disclosure. I put a no there, which is not to say you couldn't, but it's a general rule of thumb. It kind of makes the due diligence process complicated. It adds uncertain legal risk, and we advise companies to really stay within the realm of what they're comfortable sharing at that stage, rather than saying I can't share stuff with you unless you sign an NDA. We give feedback to the company saying, you know, the more you share, the better of a job we can do in valuing your company and understanding whether we can come to terms. But signing an NDA is generally not a rule of thumb for early startup companies. It comes into play a little bit more in the VC stage where you're getting into highly proprietary and detailed due diligence. The second thing that comes up is the company structure. This is, again, will be mentioned in deal terms, like the company, are they a C Corp or are they not, etc. If a company is not a C Corp, it adds a lot of different layers of potential tax liability for everyone involved. And so as a general rule of thumb, you want to kind of ask the company, does our agreement stipulate that you are a C Corp? And you want to look for that. The third thing is there are two classes of shares, often common and preferred shares. As a general rule of thumb, angel investors will have the right to preferred shares when that convertible note or SAFE converts into equity. And that's because we're early stage investors and we should have those rights. So if you ever see something saying that the investor would get a common share, that would be unusual in a seed stage. And then the last thing to consider is that a lot of these companies are raising funds, as you can imagine, from multiple people. So the last thing they want to do is upset someone either for a legal reason or for a business reason by kind of giving vastly different terms to people within a given time period or within a given round of raise. So often, if there's someone that's already leading that process or they've already signed a convertible note or SAFE, say within the last 6 months or so, the expectation will be that additional investors are following similar terms. So your capacity to say, well, I'd like to negotiate this, or I'd like to have X, Y, and Z is going to be limited by the agreement they've already established for that round with other investors. So it's a great question to ask right off the bat. Do you have a term sheet? Do you have a lead investor? Because that can be your starting point for terms, rather than saying, here's what I'd like to see, if that makes any sense. So that's kind of just a high level groundwork. I'm going to go into specific deal term moving forward. Any questions about that? Comments? Okay. So in general, for deal terms, for convertible notes, you won't see this in a SAFE. But in convertible note, you'll see specifically what the maturity period and what is the interest rate, because it starts off at debt that will be converted to equity. And so the maturity date basically is saying, okay, you're going to be paying this interest rate for whatever maturity expected, 18 to 24 months. And at that point, there will be a conversion clause that I'll get into in a minute that basically says what happens at the end of that maturity. Does the loan get paid back? Does it convert to equity? Does it roll over into another convertible note? Our goal with convertible notes is to try to hope they get to a price round. It's not to say we want to kind of do a loan at a 2 to 8% interest rate. That's not what angel investing is about. But it is the starting point, it's the structure to try to say, we expect that within 18 to 24 months, you're going to get to another round, another raise. And at that point, convertible notes will convert. The interest rate is there to help them kind of remind them that time is money, and if they can get to that sooner, the better. But it's not the primary means of return for the investment. So the interest rate is one often that as an investor you can give some leeway on, because like here at 4%, 8%, this is not why I'm investing, right? What is maybe a little bit more sensitive is maturity date. On the one hand, you want to give them enough runway to where they will get to another round. So as you say, I want the maturity rate to be 12 months. That's probably not enough time for them to say, we're ready to do another raise because we have new findings, or we de-risk the company, or we demonstrated traction, time for another round. 12 months is a short runway. At the same time, as you said, let's do it over 36 months. Then you're really stretching out that period by which you can hope to see your returns from the investment. And you're really just kind of giving them a longer term loan then. So again, convertible note, the point is not the loan. The point is to get to a priced round and to support the company in getting there. So whether it's a convertible note or a safe, there will be a section of language in there that I would describe as conversion closet. These are basically the closet to say, how do I convert that debt into equity? Or how do I convert the safe, which is a promise for future equity, into equity? So these are some of the key terms that I see, and we're going to spend a little time talking about them. One is there'll be general terms saying that the conversion happens upon a qualified financing. What is a qualified financing? It's basically a specified amount of dollars that have been given to the company in equity. Typically, we might see something around $1 to $2 million, for example. It's a large enough raise to where you say, it's time for me to get in on the action. And so that will trigger the conversion into the original investment as a safe or convertible note into a price term. There will be a clause there as well called change of control, which is often saying if the company is bought by somebody else before they got to a price round, or the owners leave the company and different set of owners come in. It can be worded a bunch of different ways. What happened to this investment? And what that often looks like is that the investors get 150 or 200% premium on the original investment. And then the two terms that are most important for the conversion. And this is probably, of everything we talk about today, is going to be the most important thing that you understand. And if you don't focus on anything else, I would focus on those two things. If there will be talk about a discount and or a valuation cap. And that basically specifies what that original investment is. So let's say you do $100,000 or $200,000 convertible note. How much is going to translate into equity? And these two terms define what that looks like. So I'm going to spend a little bit of time talking about those two terms in particular. So let me start with a word about valuations, okay? So valuations, what the chart and the data here reflects is a couple of things. So valuations reflect the company value at any given point in time. And so as you can imagine, early in the seed round, the company's not worth a whole lot. They may not have any revenue even. So an average is to see a median valuation recently was like $15 million for a seed company. SAC tend to invest more in the earlier stage than that, more like maybe $5 or $6 million valuation. At that point, it can be really hard to even say what a company's worth. They might have the greatest idea in the world, but even like Amazon.com at that stage were probably only valued in a $10 million. They hadn't proven themselves yet. As you go into subsequent round, the company is demonstrating traction, or they are de-risking the company. So they have, for example, passed the healthcare company approval with the FDA, or they have signed a contract with a major supplier, whatever it is. The company becomes worth more and more and more and more. So when you sign a term sheet for valuation, you are essentially establishing what the company will be worth as soon as they get to a price round. You're not establishing what it looks like at the bottom of this chain, saying the company's worth, $1 billion. You're basically saying, I'm agreeing today that when you price this company, I want to have enough ownership of the company to reflect that the company's worth $15 million. it's quite possible that when they get to Series A, the company will actually be worth $60 million. But your terms will say, I have a right to buy in as if the company were worth $10 million. Because when I put my money in, we didn't know it was going to be worth 60 million. So we gambled it was going to be worth at least 10. And so that's what the valuation in a term sheet is. It's not the ultimate valuation of the company, but it's kind of the deal terms you're getting at that stage in the game. So the reason that we talk about it in terms of a cap is because what the deal terms say is that the company is going, I put in $100,000. I'm going to get a share of the company. It's that the company will worth at most that cap, $10 million. You may have had a wonderfully successful raise that now puts your company worth at 60 million. But we agreed that I would have ownership as if the company was worth 10 million. So that's why I consider it to be a cap. It's an extremely advantageous term that the angel gets for taking on all the risk early in the company. Because by saying, well, I don't know if it'll be worth $60 million, but we agreed on 10, other people are coming in at 60 million, but the angel gets the right to buy in at 10 million. And so that premium, that gap is really the premium that we get as angel investors for signing convertible note or a SAFE. A discount is somewhat similar. A discount basically says, when you get to a price round, if you were valued at $60 million, the angel investor gets to go in at, say, 20% less than that. So similar, but it's referenced off the actual value as opposed to a cap at the price round. So these are the most important terms because they determine the amount of equity that a company, the amount of ownership in the company that you will own. And I'll talk more about that in a second. The other thing I want to say about valuations is they are highly fungible numbers. These are recent numbers from Q3 of 2022 to 2021. Apparently, later stage companies are plummeting in valuation. Seed companies have actually risen in valuation. They may be lagging if we head into a depression. A recession possibly. But the key point about this is you'll hear sometimes companies say, well, the last time we raised money, we were valued at $10 million. Well, that was a year ago, and we're now facing inflationary pressure and a recession coming on. $10 million may actually look like a step up rather than flat. So the valuations are very much based on market conditions. So in the last few years, we've had a lot of inflated valuations where if you so much as even could demonstrate a small thing, you might be able to go and raise enormous valuations. That doesn't mean the company's worth that much. It just means that that's the prevailing kind of market sentiment at the time. So one of the toughest things for investors to do is to say what the appropriate valuation. It depends on the market, depends on the business, depends on the risk, depends on a lot of different things. And I will also argue it may not really matter all that much at all. And I'll talk about why in a second. Talk a little bit about value caps already. So as I mentioned, it does a few different things. It establishes an upper limit on the conversion price. So we got in at a company saying if we agreed it's going to be worth 10 million, ended up being worth 60, but because I got in early, I get the value of the 10 million. I don't have to compete now for saying it's worth 60 at a later date. It protects investors against dilution. Dilution is basically every time more money comes into a company, your share kind of will shrink. And so if you come in and suddenly the company is worth a huge amount, that amount of money can just swamp your ownership of the company. And so by kind of saying, well, I got to buy in at a lower valuation, you end up protecting how much of the company you own, at least in that round. So the other thing you'll see, let me pause right there. Any questions about valuation? I have a lot more to say about valuation, but any questions about the purpose of valuations and why valuation even exists on a term sheet?
Just a quick question on that last one where it says if the valuation cap is higher than qualified financing, investors receive no benefit. I'm afraid I'm not quite following that point.
Yeah, let me articulate on that. That's a great question. So I gave you an example of a company where we agreed on a 10 million valuation cap, but in the price round, the company came in at 60 million. That's awesome, right? Because as early investors, we got the company we got shares or equity in the company as if it were worth 10 million, but the company's actually worth 60. So, however, what happens, and we should have that because we're taking risk early in the process. However, suppose that we made an agreement saying we're going to get in as if the company's worth 10 million, but then when the company has a price round, it's priced at 10 million. Then that means those later investors that are now coming in, they're buying in at the same rate that we bought in, even though we took so much more risk jumping in early. So we get no benefit. We might as well have waited.
Got it. Thanks. So yes, if there's a down round, we're all sad.
And so that's why the notes typically have a discount and a cap. And so you're taking the 24% or 25% discount as the benefit for coming in early. That's sort of the prize for coming in early. If the valuation follows what you expect it to have, and then only when the valuation is unexpectedly high do you get the extra benefit. I see some hands that are going up, Alex.
Yeah, go ahead, Dennis.
Hey, Alex, thanks for sharing. And I just have a quick question regarding the cap and the final exit, the relationship between those two. So let's say the conversion happened at the 10 million cap, and the company at a very late, multi years later, exit at the $300 million acquisition. Does that mean our money actually get a 30x there? Is that an easy calculation, or is there more ounce into it?
No, I have some numbers I'm going to show you later about maybe what the return looks like. But I think the way to think about it is a little bit more. The valuation will determine what percentage of the company you own. So if you have I'll use simple numbers. If you've got a 10 million valuation and you put in a $1 million investment, you own 10% of the company at that point. If you have a 100 million valuation.
The valuation is being used at the point at which you do the conversion, not when you're doing the exit.
Right.
Just a follow-up question. Insofar as you have a price evaluation cap and a discount, is it essentially a double dipping scenario, or would the discount only apply in the case of a down round?
No, usually, I mean, a favorable agreement will say that there's a discount or the lower a discount or the price cap, not an and.
Okay.
That's an important thing. I imagine if someone could try to write an agreement where they say and I have had conversations with folks who said, well, it looked like a double dip, and so I don't agree to that. It's an or in most cases. Yeah.
Great, thanks.
And in many agreements, actually, only one of those is applying. I've seen agreements where there's only a discount, there's no cap mentioned, and others where there's only a cap and no discount mentioned.
In general, the cap is protecting against unreasonable growth. And so you give them a convertible note, and then there's some overly inflated valuation that's created in some way. And then you end up getting 0.5% of the company instead of the 10% you expected because of somebody else's investment strategy. So it's just designed as protection. It has the benefit that if it does have extra growth beyond what you expect, then you get a premium. But for the most part, we're expecting that the benefit comes from for the early investor comes from the discount.
Yeah, I mean, to circle back to your question, Dennis, should to be clear, a little bit of math here. So let's say that I get a seed angel investment early on, and I say we've agreed a cap of 15 million. And so based on, let's say I put in 1 million, I'm going to own 1.5%, very roughly speaking, of the company. However, right, but that doesn't happen. I don't actually own the 1.5% of the company. A convertible note seed is not equity. I'm just saying I have a promise to be able to take my $1.5 million investment and own the company as if it were worth 1.15 million. The reality of what is happening is that company has now gone to a Series A, and they have raised the company for 64 million. If I had taken my 1.5 million and I had to buy in at that rate, I'd own a much smaller percentage of the company, right? Because 1.5 million of 65 million is a tiny percentage. But because of my cap, I get to buy as if it were worth 15 million. Everyone else that's coming in the Series A is investing as if the company were worth 65 million. So every one of their dollars is getting a smaller percentage ownership of the company than my dollars did. That makes sense. And then if we go forward to your point, let's say that they IPO at $1 billion. What percentage of the company do I own? Well, when I put in 1.5 million at this stage and I owned, 10% of the company, now I might still own 1.1 billion. It's not quite that simple, because in every one of these rounds, if more money comes into the company, my 10% is going to drop. It's going to get diluted from 10% to 9 to 8, because more money coming in. So it's almost like the pie gets squeezed, if you will, for everyone that was already in there before. Pie becomes bigger, but each portion of the pie becomes a little smaller. But you get in early as a starting point. The founders are facing the same thing. They start the company by saying, I own 50% of it. And if they get down this path, they essentially are getting diluted, and they only own maybe 20% by the time they get to an IPO. Same thing's happening with the angels. But the cap gives us a nice percentage chunk at the beginning relative to what's going to happen in the next round.
Thanks.
So often companies are upset when we say we want a 25% discount. And I want to sort of go through the thinking about if I'm investing in a 10x company, that is a company that will be 10 times bigger in revenue than it was when I invested in a year. So it's growing by 10x a year. What's the advantage, or what's the discount that I would have to represent the value creation of that 10x company?
Mm-hmm. Yeah, is that a rhetorical question?
No, it's I think that you can put a number on it, and it goes to show that the 25% discount is abnormally low. So if I have a 10x company, like everybody thinks that they're a great company growing big, then I should get 1,000% discount because it's a 10x company. And so I'm investing in that, I'm giving you the money and it's sitting there, and a price round is not going to happen for another year. So then the value, the percentage of the company I would get is much, much lower by a factor of 10 because of that, right? And that's why we want a cap, and that's why we want a reasonable discount, but we can't actually negotiate a discount at the level of the growth that a good 10x company would produce.
Right. So there's been a lot of detail here that I just went over, but essentially these terms, discount and valuation cap, so often the only terms that sometimes you get to negotiate in the term sheet. The other stuff sometimes might be picked by a lead investor or may not be significant. However, I've given you a lot of technical detail into some of those things. I want to kind of talk about, I'm going to talk about one thing, pre and post money, and then what does it really matter? I want to touch base a little bit on that. So real quick, a question about pre and post money. You'll see this money, the term going around in term sheets all over the plate. All it really means is, let's say to my company's worth $1 million. Someone give me $250,000. I put that in the bank. My company's now worth, $1,250,000. That's post money, pre money before they gave me money. And because some of the round can be very, very large, there can be a distinction between pre and post money. If the round is very small, then those numbers are not going to matter. Difference is not going to matter as much. So the reason they matter to us as investors is simply because it gives clarity into what percentage of the company are we talking about owning. So you can see on the left, if I say I want to agree to a pre-money cap of valuation of $1 million, and as an investor I put in $250,000, then that comes to the company getting that got to a 20% ownership. Whereas if we define the valuation as 1 million, my 250,000 post money will essentially be worth 25% of the 1 million. So it's a linguistic thing that is critical. It has some impact to dilution, but more than anything, it just gives you clear optics on saying what percentage of the company am I agreeing to own. That makes sense. And this, I think, is what plays into the real meaning of valuation. And I'm going to explain why I think that. Because there are a lot of ways. So one might say, okay, so what's the right valuation for a company? You know, 5 million or 10 million? How do I know? And am I going to create all these really detailed spreadsheets to try to figure that out? There are methods, particularly VCs use when a company has a lot of history or customers and revenue that you can use in terms of like revenue multiple, discounting the cash flow from the money they're making and the projections in the future that you have that are based on something grounded and real. They're comparable, for you look at other companies and say, I think this is similar. There's things like the point system will say, well, I'm going to get 5 points for management. I'm going to get 3 points for the patents, et cetera. And that gives me a sense of what the value is. None of these work very well in a seed company because there's often not revenue to look at. If they're truly an innovative company, the comparables are helpful, but not specific. So one of the methods that I find most useful is to kind of reverse engineer the whole question. Instead of asking the question, what is this company worth? You can ask yourself, what percentage of the company would I want to own to feel like this is a worthwhile investment? And so I want to give you a couple of examples here to think about. So you say I'm going to put $100,000 and company A is saying, we have a post-money valuation of $5 million. And you're working with company C that says our post-money valuation that we're comfortable with is 50 million. Ultimately, that means that when it converts to equity, your $100,000 will be a percentage of the company. The one with a small valuation, you'll get a bigger percentage of the company than the one with a big valuation. So while it might be exciting to say, yes, I want to invest in a company with a big valuation, they're going to be big and successful, it might also mean you own a very small percentage of the company. And ultimately, a little bit to Dennis's question, and this is, again, vastly oversimplified, but if this company exits for 25 million, then my percentage is going to translate into a good return. Where this big company that I agreed to a high valuation because I own a small percentage, they need to even have a bigger exit for me to see a comparable return. And so you can almost look at it from the other way around. Like if I look at company C, I can ask myself, do I really think they're going to exit at $250 million? Maybe. Company A, same great idea. Do I think they can clear $25 million in an exit? Absolutely. This is going to be so much more of an attractive investment. And I don't need to quibble as much as to whether they're $5 million or $7 million. I just kind of say, yeah, this is looking attractive. This one is looking overvalued. So that's one approach to take to it. And I think it's a better approach than kind of trying to figure out a company C worth 30 million or 60 million. It's a little bit more, what are they worth relative to what we really think the potential of the market is, put them out there. So that's one way to think about valuations. That being said, I'm going to come back at the end of the presentation and suggest why you perhaps should not even consider this at all. But if you are going to consider valuation, this is one way to do that. And we do have a couple of companies in SAC. Most of them are like company A, and there's one that looked like company C. And in that case, it might make sense to look at the valuations and kind of say, how confident are we in their ability to reach the kind of market potential that they claim they'll be able to reach? Any questions about that? Okay. Let me move on and talk about a couple of other considerations in term sheets. These are terms that you might see. They are not boilerplate terms. You won't see them in every term sheet. In some cases, you have to request them. They might be in a side letter, as they call it, to the term sheet. But one of them is data rights. Now, this can be important because it's not uncommon as an investor. You put money in a company and then you never hear from them again. And you might be like, well, why don't they tell me what's going on? And the answer is because they don't have to. As long as they're fulfilling their legal obligations, there's no reason for them to provide information back in terms of a newsletter or in terms of an update to the financer, unless it's written into the agreement that I have a right to those kind of updates on a quarterly basis or what it might be. So it can be helpful to have that. They can be difficult to enforce. They might not even be worth enforcing, but you can request them. The board observer is an option to get even closer to the company, saying I want to have someone that's part of the investment just sit in on the board and receive the same material that the board receives. It's kind of had the same objective as data rights, give me visibility into what's going on. I don't have a voice, I don't have a vote on the board, but I get the visibility that the company is holding its internal standards to. And that might be particularly helpful if you are an investor interested in subsequent rounds, because then you are tracking the company very closely. You're getting all that rich information. You don't have to reopen due diligence. You pretty much have been following them all along. Companies can be reluctant to do board observers unless you write a large enough check, because it's more cooks in the kitchen, more people that want to see stuff. Some of that NDA concern that I mentioned early on gets heightened because they're saying now we have an investor that really deep inside the company, are they confidential, etc. But you can request it. The most favored nation is a clause that essentially says, if you make a deal with other investors, we want to have comparable terms. So it's a way of kind of making sure that the investor hasn't given you a convertible note with a really, with one valuation, but then given other investors much better terms. Most companies will fight a more favored valuation. It makes sense. The problem comes in that it can be very subjective to say what is a favorable term versus not a favorable term. So let's say that I gives you a better interest rate, but a longer maturity period in a convertible note. What exactly does that mean? Better terms, worse terms, etc. It can also become a legal entangle, because now if they agree to that, that means that in the future it hampers their ability to raise additional money on terms that might be appropriate for the market. So if we're, for example, headed into a recession, it could be that in the future they need to raise additional money on a down round, something. And if they do that, they're getting hit not only by their challenge to raise money then, but by their obligation now to go back to a previous investor and give them comparably downgraded terms. So it's nice to have. I think ultimately as an investor, you want to stay focused on the fact that you're there to help them be successful and to get to that price round, not to say, am I getting all the very best terms that I can? So if you have a strong suspicion that you need a more favored nation, it might be a red flag that are you fully trusting of the company and what they are going to do in the future subsequent raises. That's just my opinion. Some other people have a little bit of a different opinion, that it's there to protect your investment. Pro rata rights are your right to basically buy in future rounds. So Dennis, if we were talking about earlier, every subsequent round, your portion of the pie gets diluted because more money comes in. So pro rata right just says I have a right to buy in additional shares at that round to maintain my ownership of the company. So it's almost like saying I'm going to plump my share back up every time. You don't have to exercise them, but you do that. This is another one that companies don't tend to like to agree to, because if they start agreeing to giving it to too many investors, then those investors might just hold on to their pie, and it pushes the dilution of others even further down. So it can make it difficult to do subsequent raises, because then people say, well, your existing investors are going to keep us from getting the kind of share that we would like to have down the road. So they'll fight it, but it's a nice thing to have, especially if you really believe in the company long term and think they're going to need a lot of subsequent rounds and a lot more infusion of capital. So again, not standard, but things you can negotiate for and talk about. So I want to just maybe end a little bit on a brief note about 3 considerations that I think throw almost everything that I just said out of the throw it out. The first is that when you're negotiating terms, you're trying to maximize your return, like thinking, oh, yes, I would like to get an 8% on my interest rate instead of 6%, and I would like a low valuation so that I get a bigger share of the pie and so forth. Valuation cap. The flip side of that is that the more that an investor gets for themselves, the more it could challenge them into subsequent rounds. So a higher interest rate on a convertible note means that they're putting less of their capital to work potentially in the company, more towards investing in or paying you back at a time when maybe capital is really critical for them to grow and to accelerate the growth. Remember, you want to get them to a price round, not to get to a great interest rate on your return. Similarly, like really fight for more favored nation, and then they lose out on a big investor in the future. Like, I don't want to give you money because I want really great terms, and you're going to have to now give it to this other guy that you did business with, 2 years ago. So I'm out. That is not good for the company, and also not good for you, because that money might have really been what they needed to get to the next stage of growth. So terms have to be looked at from that perspective. You're there, especially as a seed investor, to really help the company succeed and to get to that wonderful exit you want them to see, not to quibble over every little thing on the term sheet. Second perspective that I have is that looking at these terms can be helpful, like I was showing you in company A versus C, when there are vastly different valuation, and you're saying, oh, okay, which company, I only have this much money. Do I put it over here? Do I put it over here? Where am I going to get my better return? Maybe you want to really scrutinize that carefully and say, okay, one of them is a safe note at this valuation. The other one is a convertible note with this interest rate, etc. But often you're really just looking at which company is more likely to succeed. Right? Because more than half of our seed investments are going to go bankrupt. They're not going to succeed. And so should you put your money on the one with better deal terms, or do you put your money on the one that you truly believe is going to have an exit? Because what's worse than a company with really great deal terms is one that doesn't exit at all. So I think, for people who are portfolio managers, looking at deal term can make a lot of sense, because you're making trade-offs, or you're thinking about how am I going to take $40 million over the course of a year and selectively invest it where I can get the best returns. But as sole investors looking at companies one at a time, you're really going to focus a lot more on, do I think this company is going to succeed or not succeed? And that's why we, in SAC, we tend to not to focus that much on the other terms. We want to have oversight over them, but our decision process is much more on, do we have confidence that the company is investable and has a good chance of succeeding? So to really kind of drive that point home, I'll give you these 3 companies and I'll ask you which one had the best deal terms. And the answer is, it really doesn't matter. Because ultimately Quibi went bankrupt spectacularly. Theranos had a scandal, and only Amazon produced a return. So I really don't care what the return sheet looked like. That would have been the one that I would have wanted to sign. So just some food for thought there. And that concludes my presentation. I'm happy to use this time to discuss or see if anyone has any other questions.
That was excellent, Alex. Thank you.
So I put into the chat a bunch of terms early on for what a Series Seed agreement would look like, or what the YC documents look like. Those are useful to sort of compare the details of all of this. And I put the term sheet that we've sort of been using for Seattle Angel Conference in there as well. Any other thoughts from anyone? Questions?
One thing I will add, if you're interested in learning more about this, the Y Incubator and Cooley, they have templates that are widely circulated amongst companies as the template for a safe, or the template of a convertible note. So you can go and look on their website and you'll be able to pull them up, and they'll have blank bases on them, but you'll see all the legalese of what's in these agreements. And you'll start to see some of these terms pop up and go, oh, okay, that makes sense to me. And you can dig further into exactly how these terms are written and claused and so forth. So.
One of the things you didn't mention is that we have recently put into the term sheet for the Seattle Angel Conference a form of revenue redemption. And so when you get to the end of the term, 18 months in, and the company has not had the next round of funding, so there's not a price round on the table, what are you going to do? Are you going to extend it? Are you going to, call it and kill the company? Just what are you going to do? And one of the choices is we're going to convert to stock at a, Series C kind of process at the cap that we agreed to on the note. And then you're going to buy back our stock over time out of revenue. And that helps us get out of the companies that are perpetual companies that are not ever going to exit and are never going to get another round of funding, that are still producing revenue and producing margin. So there are other options that you can put into terms. Of course, these are non-standard, therefore it triggers the opposing lawyer into action. And so you have to spend some time disarming that other lawyer. But having some mechanism by which the perpetual companies become some kind of return for you is one of the things to think about. And then on the other side, as an entrepreneur, you should figure out what you're going to do if you can't raise your next round.
Yeah. And I think that touches on an interesting thing as well. I mean, if at any point, I think in your term negotiation with the company, you're feeling like you need to really protect yourself, the bigger question you should probably be asking yourself is, do I have confidence in the management team? Do I have confidence in the business process? So, I've looked at companies that look like they might become a licensing house. So they've got great technology. Maybe the founder might be very happy to take the technology, sell it to a company, have a great revenue stream coming in and never have an exit. And so I could focus on the term sheet, kind of saying, how do I get a revenue redemption out of that? Like John said, well, I could ask myself, is this a company I want to invest in? Because I'm having some timidly red flags about this. Or do I think they're really motivated to go for an exit? And I'm not too concerned about that. So you can look at it from both perspectives, a business and a term sheet perspective.
Anytime you have tingly feelings about a startup, it's the answer should get very close to no very quickly. Any other questions from anyone? Cool. Well, Alex, thank you so very much for putting that together. It was very helpful, I think, and I'm very happy to have you do that.